Hey y'all, I've gotten a lot of requests to address this. What I've discovered is a false narrative that the Biden-Harris administration is penalizing people with higher credit scores by raising their costs to be higher than those lower credit scores when it comes to mortgage borrowing. That is unequivocally false. Now, I need to break down these numbers and deconstruct how this disinformation is being spread, but it's going to take a while. So, if you don't take anything else away from this, let me just say that anybody who feels a sense of accomplishment, who feels a sense of my life should be better than yours because I have been responsible and I have a great credit score and you do not, you can take solace in the fact that if you have a better credit score, you're going to be paying lower fees, lower interest rates than a person who has a worse credit score. Absolutely nothing is changing about that for you people with higher credit scores. Now, let's deconstruct all of this stuff and make it make sense. So Tucker Carlson and the right-wing media is running with this narrative that Biden is penalizing people with better credit scores in favor of people with lower credit scores. Actually, the way I was alerted to this was somebody tagged me on a post from Egypt Sherrod, and I love her. I'm a huge fan of hers. I was rooting for her on Rock the Block. I was super happy that she won. I watched her show with her and her husband. This is not an Egypt Sherrod diss one way, shape, or form, but this is what she had to say.
For the first time in history, people with higher credit scores will be charged a higher interest rate when purchasing a home than those with lower credit scores. What? What you say now, Egypt?
Sorry, Egypt, but that's just not true. It is not true under any scenario that people with higher credit scores will pay more fees than a person with lower credit scores. Okay, so before I get to breaking down the numbers about the fees, I want to address a different part of her caption. It was not in the video verbally, but in her caption, initially she said that FHA was lowering the mortgage insurance premiums, and as a result of that, they are increasing fees on other people. That is inaccurate. The fees that she's referring to comes from a separate entity. The mortgage insurance premiums do come from FHA. Now, the FHA mortgage insurance premiums are self-funded. So it makes absolutely no sense to suggest that self-funded mortgage insurance premiums are being reduced and paid for by a completely separate entity that has nothing to do with FHA, the Federal Housing Administration. Mortgage insurance premiums are paid by people who actually have an FHA loan, and those insurance premiums cover FHA federally backing FHA loans. So, two completely separate issues. But the reason why disinformation works is it tries to conflate two morsels of truth and repackage it in a way that pits one against the other. So, let's talk about the fees. Now, the fees are called loan level price adjustments, LLPAs. The FHFA, which is not the same as FHA, Federal Housing Administration, the Federal Housing Finance Agency, is a regulatory independent agency from the administration. So, yes, Biden has appointed a person to lead FHFA. However, FHFA is independent of the administration in the sense that they do not take marching orders from Biden. They're not part of the cabinet. They're not part of the executive office of the president. So that's just a clear distinction that I wanted to make. But at any rate, the FHFA is responsible for the supervision, regulation, and housing oversight of Fannie Mae, Freddie Mac, and the Federal Home Loan Bank System, not over FHA loans, okay? So what they've done is they've directed changes to their loan level price adjustments, LLPA's matrix. That is supposed to go into effect May 1st. So what the right-wingers have done, and some people who maybe earnestly have not understood the nuances behind what is being presented have done, is they've taken apples to oranges comparisons to try to portray this idea that if you have a higher credit score, that you are worse off now than a person who has a lower credit score. That is unequivocally false. That is flat out not true. But they've also had apples and oranges comparisons to say that over here you get an increase and over here these people get a decrease. Now, I will say what is true. It is true that if you have lower credit scores, you are getting penalized less for that with the new LLPA matrix. Even with you getting penalized less for having a lower credit score, you're still paying a higher fee than people who have a higher credit score. Now, there are a couple of things that I want to break down about how the fees have changed. And for the record, I just want to say this is not a caping for Democrats video. This is an correcting the record. Disinformation needs to be stopped video. If you're wondering about my credentials, I have a bachelor's in business economics from UCLA with a minor in accounting, and I have an MBA from Northeastern University specializing in finance. So I know math. But anyways, back to the schedule program. All right, so what I want to say is there's two key differences in the old LLPA matrix and the new LLPA matrix. One key difference is that the old LLPA matrix topped out at 740. So anybody with a score above 740 all got treated the same. Well, now it is actually 740 to 759, 760 to 779, and 780 and above. So there are three new categories above 740 as opposed to just one. And those categories have different fees. Now let's talk about the fee increases. Much has been made about the idea that a person with bad credit who has a high loan to value ratio of 95% is going to have lower fees than they had before. But what they haven't told you is that every person who has a 95% loan to value ratio will have a lower fee than before, including people with higher credit scores. If you have a credit score of less than 639, your old percentage was 3.75%. Now that percentage is 1.75%. But if you have a credit score of 780, your old percentage was 0.75%. Your new percentage is 0.125%. For the same person who's paying 1.75%, you're paying 0.125%. So they got to decrease, you got to decrease. Now, it is true that people who have a 95% loan to value ratio are paying a lower fee than those who have an 80 to 85% ratio of loan to value. So you get to make the decision. Do I want to put less down and have the lower fee, but putting less down comes with a higher interest rate? Or do I want to pay the higher fee and have a lower interest rate? That's where all of this stuff comes in together. And lenders also sometimes absorb these fees. And so that's part of your overall APR. So the bottom line is this. There's no scenario where you want to have a lower credit score than a higher credit score if you're looking strictly at the fees. There's no scenario for that. Does it suck that you had a higher credit score and now your percent has gone up a little bit in terms of fees? Absolutely. Just like it sucked if you didn't get a chance to refinance when mortgage interest rates were 2%. Just like it sucks if you didn't get a chance to finance or buy a house when interest rates are 3%. Fees are going up. That sucks. But the idea that you're being penalized for having better credit is actually absurd. And it's just not borne out by the numbers. And if you're upset that people who have lower credit scores are being penalized a little bit less, yet still paying significantly more than you are if you have a higher credit score, then I think that that's a problem you should probably really reevaluate, particularly when it comes to your politics, where I hear people constantly demand that we close the racial wealth gap, that we close the Black home ownership gap, and a number of things. Part of the way that we do that is by not penalizing people so much for things like their credit score, which disproportionately impacts Black people.